Something shifted in the silver market this week, and most investors completely missed it. The May inflation report just confirmed what many feared. Headline CPI came in at 4.2% annually. Energy costs are surging. Shelter prices are rising. And core inflation, the number the Federal Reserve watches most closely, accelerated to 2.9% year over year. That is the highest core reading since September of last year. And right now, silver is sitting at $64 an ounce, having already pulled back more than 47% from its all-time high of $121 reached in January. What you're about to hear in the next few minutes could completely change how you think about that correction. Because the data underneath this market tells a very different story than the price chart currently suggests. And if you have ever watched silver explode higher after a major macro catalyst, you know that when it moves fast. Stay with me here, because this is exactly where the analysis gets serious. Let us start with what is actually happening right now. The inflation number confirmed this week was not a surprise in its headline figure. Markets had priced in 4.2%. But here's what almost nobody is talking about. The monthly core CPI reading came in at just 0.2%, below the 0.3% estimate, and well below the 0.4% surge seen in April. That monthly deceleration in core inflation is significant. It tells you that the underlying inflationary pressure, while still elevated, may be losing momentum at the margin. And that is the precise kind of reading that historically causes institutional money to recalibrate its expectations around Federal Reserve policy. Because when core monthly inflation surprises to the downside, even slightly, it opens the door to a conversation about when rate cuts might return. And silver, as every experienced precious metals investor knows, is highly sensitive to real interest rate expectations. Now pay close attention, because this is where the story gets serious. The Federal Reserve is holding its June 16th and 17th FOMC meeting next week. This is the first meeting chaired by Kevin Warsh. Markets are pricing a 97% probability of no rate change. That decision is essentially settled. But what is not settled is the dot plot. The Fed will publish its updated interest rate projections alongside this meeting. And after a CPI report showing monthly core deceleration, there is a real question about whether the dot plot signals any path lower for rates in the second half of 2026. If it does, even subtly, the impact on silver could be substantial and fast. This is exactly why smart money is moving early. Institutional hedge funds currently hold near historically low net long positions in silver futures. The managed money category on COMEX sits at just 4,469 net long contracts. That is significantly below typical exposure during major silver market moves. What that means practically is that the fuel for a major rally is sitting on the sidelines waiting. When institutional money begins rotating back into silver, there is very little resistance between current prices and a sharp move higher. The COMEX registered inventory coverage ratio tells you something equally important. Only about 13 to 14% of outstanding silver futures contracts are backed by physical silver available for delivery. That is not a comfortable buffer. That is a structural vulnerability in the paper pricing mechanism that has been building for months. And it exists in a market that is simultaneously running its sixth consecutive annual supply deficit. The Silver Institute projects that deficit at 67 million ounces in 2026 alone. When you combine a paper market with razor-thin physical backing, a persistent structural supply shortfall, and institutional positioning sitting at historically low levels, you have the ingredients for a very sharp repricing event. The only question is what the catalyst will be. And right now, there are several lining up at once. The Federal Reserve dot plot next week, the European Central Bank's ongoing rate path, and the broader question of whether the global inflation cycle is peaking or reaccelerating. Let us talk about the European dimension, because this matters enormously for viewers in Europe. The ECB has been navigating the same impossible situation that central banks everywhere face. Inflation remains too high for comfort, but growth is fragile. The euro has been under pressure against a range of currencies. European savings are being quietly eroded by a combination of above-target inflation and interest rates that remain historically insufficient to compensate savers. For European investors, silver is not just a commodity speculation. It is one of the only assets available to ordinary individuals that sits outside the banking system, cannot be inflated away, and has never gone to zero in recorded monetary history. The relative value case for silver in euros is arguably stronger today than it was 12 months ago. And yet silver is 47% below its January peak in dollar terms, and even further below that peak for many European buyers who saw their purchasing power compounded by currency movements. That kind of dislocation does not persist indefinitely. Now let us talk about the scenarios you need to understand going into next week. Scenario 1 is the bullish case. The Fed dot plot for June signals fewer rate hikes than the market currently fears, or hints at the first potential cut arriving in late 2026. Kevin Warsh, who has publicly noted that productivity-driven disinflation from artificial intelligence could help bring inflation down over time, moderates his tone. The dollar softens on the reduced rate expectations. Real yields pull back. Silver, which is trading near long-term technical support around $63 to $64, catches a bid from institutional money that has been waiting for exactly this signal. In that environment, a move back towards $75 to $80 would be entirely consistent with historical patterns, following similar macro pivots. Bank of America and JP Morgan both maintain institutional year-end targets meaningfully above current prices. The Reuters commodity poll now projects a 2026 average silver price of $79.50. Silver would need to move substantially from here just to catch up to institutional consensus. Scenario 2 is the bearish risk. The Fed dot plot surprises hawkish. Warsh signals a willingness to raise rates if inflation reaccelerates. The dollar strengthens sharply. Real yields spike. Silver breaks below the $63 technical support level. In that environment, the next meaningful support sits near the $54 to $56 range based on technical structure. That is a painful outcome for short-term holders. But here is what changes the equation even in that scenario. The structural supply deficit does not disappear because the Fed sounds hawkish for one meeting. Industrial demand from solar manufacturing, electric vehicles, and artificial intelligence data centers continues to consume silver at a rate that the mining industry cannot match. Oxford Economics projects automotive silver demand growing at 3.4% compound annually through 2031. Solar panels alone could consume over 200 million ounces of silver annually within the next 3 years. Battery electric vehicles use between 67 and 79% more silver than combustion engine vehicles. These are not speculative projections. They are contracts already signed, infrastructure already being built, and government mandates already written into law across Europe, Asia, and the United States. The financial market is currently pricing silver as a rate-sensitive monetary asset. The industrial market is consuming it as if the supply were infinite. That disconnect is the most important thing any silver investor needs to understand right now. What happens next could shock most investors. Because when markets reprice an asset that has been trading on one set of assumptions, while reality has been moving in an entirely different direction, the adjustment is rarely gradual. Look at what happened in 2011 when silver moved from $27 in January to nearly $50 by April. Look at what happened in the first weeks of January 2026 when silver surged to its all-time high of $121 in a matter of days. These are not aberrations. They are what happens when a market catches up to fundamentals that have been building for months beneath the surface. The correction from $121 to $64 has shaken out enormous amounts of speculative positioning. That is actually healthy for a market building toward a more sustained move. Weak hands have sold, physical demand has continued, the deficit has deepened, and institutional money is sitting at historically low exposure levels, ready to re-enter at the first credible signal that the rate cycle is turning. That signal could come as soon as next week. Here is what you should take away from everything you have just heard. The inflation data is confirming a complicated picture. Headline inflation remains elevated at 4.2%, but the monthly deceleration in core prices is the detail the market will be watching. The Federal Reserve meets next week for the first time under new leadership, and the dot plot update represents a genuine inflection point for precious metals. Silver sits deep in correction territory despite a structural supply deficit now entering its 6th consecutive year. Institutional positioning is at historically low levels, meaning the fuel for a major move higher is built up and waiting. The industrial demand story from solar, electric vehicles, and data centers is accelerating regardless of what the Fed decides next week. And European investors face the added pressure of persistent inflation and currency weakness that makes hard assets increasingly difficult to ignore. This is not a prediction that silver will move tomorrow morning. Markets are complex, and the bearish scenario is real and must be understood. But the weight of evidence, the structural supply shortfall, the positioning data, the inflation trajectory, and the institutional price targets all point in the same direction. The window to position ahead of the next major move in silver is measured in weeks, not months. If this analysis gave you something valuable, subscribe to this channel right now and turn on notifications so you never miss an update on gold and silver. Drop a comment below with the word silver if you are positioned in this market, or gold if you are watching gold more closely right now. This channel exists to give you the analysis the mainstream financial media overlooks. And right now, the story in precious metals is just getting started.